right, hello. How are you? My name is Mark, and I am the head of the Benzinga Trading School, so I hope you'll check it out. And I just want to do a quick review of the market here because the Santa Claus rally continues, for now at least. If you're long, the old saying, the trend is your friend. So you just stay long, and maybe it's overbought, maybe it seems irrational, but who cares? The market knows more than we do. But be ready, I think, for a pretty quick turnaround. First of all, this is the S&P right here, the S&P 500, it's the spider, the ETF. You can see it's really overbought. This bottom half of the chart here is what we call the RSI, it's the relative strength indicator. That's the name of it, but it's momentum measurement. Measures how far something has moved from time period A to time period B. And when we get above its typical or usual trading range, we call that overbought. Now, the reason why that's important is because things that are overbought tend to reverse. A lot of Wall Street trading strategies are based on this concept of reversion to the mean. So when things get overbought, it's going to draw sellers into the market, and their actions may push the price lower. Another thing to point out, too, where we might kind of stall out, I mean, I know it's kind of hard to believe, but we're only 5 points from an all-time high, which was made back in the very end of November of 21. So we tend to run into resistance at former peaks. I'm not saying the market's not going to go on to make new highs, but there's a tendency to run into resistance at former peaks. You can see it happened here. And the reason why, see, here was a peak. Actually, that's 2 peaks. And then here. And there's a reason why this happens. It's because there's people who bought back here who've been underwater since, and when it finally gets back up to their price, if they say, if I can get out of break even, I'm going to. So remorseful buyers selling at a level that was a former peak can make that resistance occur again. Now, I am primarily focused on 2 things. One is the bond market. We could just look at this ETF, TLT. Now, remember, bonds trade inversely to ETFs, which means if this goes, no, I'm sorry, let me say that again. Bonds trade inversely to interest rates. Sorry, I said that wrong. So if this rolls over at this level here, which has become resistance, there's a good chance we keep going, we start to sell off. Now, why does that happen? Well, you got people who bought back here, who, assuming they still hold it, they've been underwater since, and they say, oh, if this ever gets back to my price, I'm going to sell to get out. So you have this is a different manifestation of buyer's remorse showing up as resistance. Now, a lot of times you sell off of resistance, as you can see here and here and here. And that's because some of the traders who want to sell, they notice the price isn't moving any higher. So they just kind of assume that there are new sellers coming into the marketplace. Because if something's going higher, there's not enough supply. If it stops going higher, all of a sudden there is enough supply. Supply being sell orders. So selling off of resistance is a pretty common phenomenon. And if we start to sell off here, that's going to push interest rates higher, and that's going to be bearish for most equities. And I think probably the key sector to watch is the financials here. And what's really kind of interesting is over the past couple weeks, the financials have become the second biggest sector after technology. For as far as I can remember, at least a couple of years, healthcare was the second biggest sector. So they've kind of shifted each other or past each other. So it's just something that is kind of unusual for something to change like that. And I could show you what I mean. You can go get a look at the fact sheet of this SPY if you're a SPY trader. It's at ssga.com, State Street Global Advisors. And see here, financials is now 12.94% of the overall market. Healthcare is 12.47%. So they just switched there. So I think the financials are probably one of the most important things to watch, other than the bonds. If we reverse, there could be support at this 37 level. Levels that were resistance have a tendency to become support. All right, you can see that right down here. Is our seller's remorse. People sell, and the price goes higher. A lot of them say, I shouldn't have sold. If I could buy my shares back, I'm going to. So they place buy orders at the level that have been resistance. And if there's enough of these buy orders, it converts it from resistance into support. So if this reverses and it becomes support, that could set the stage up for another leg up. But if the financials crack, I think that's going to bring the broader market down. And other than the banks, the rest of the financial sector really doesn't look that good. It doesn't look bad, but I'll just take a quick look here at Berkshire Hathaway before I go. The biggest stock in the market. Actually, that's BRKB. How about that? What is it? $554,000 a share. People always ask me why Warren Buffett never cut the share price. Usually companies, they split their shares, but I have no idea. But anyway, there's this Berkshire B, which is the stock that us mortals trade. And, all right, you can see like we're in a range here. This is the biggest company in the financial sector. JP Morgan is the biggest, or sorry, the second biggest. And look at how overextended it is. It's really overbought. So things that get overbought tend to reverse. And if the banks reverse, that could reverse the financial sector. That could bring the broader market down. All right, thanks everyone. Make sure you check me out at the Benzinga Trading School. And I hope to see you soon. Thank you.